How do banks create money? Ever wondered how do banks create money? And why are they willing to pay you interest when they have to do all the hard work of keeping your money safe? Now what if I told you that banks are artificially creating money every day? Let's start with the basics. You deposit your money at the bank and they give you a small amount of interest. Then, they take that money and lend it to people and businesses while charging a much higher interest rate. The difference between the interest they charge on their loans and the interest they pay you is the profit that the bank makes. This is why banks are willing to pay you interest for your deposits. In order to lend more and make more money, banks need to attract more money from deposits because deposits create loans. But aren't the banks supposed to be keeping your money safe somewhere so that you can take out your money when you need it? Well, sort of. Banks have a unique system called fractional reserve banking, which basically says that only a fraction of deposits, usually around 10%, need to be held in cash and they can loan out the rest. This amount is set by the central banks or the Federal Reserve and acts as a cushion for when customers want to withdraw cash from their account. Now here's where the money-making magic comes in. Let's say you deposit $10,000 into your savings account. If the reserve requirement is 10%, the bank must keep $1,000 and can lend $9,000 out to another customer. Now, you have $10,000 in your account, another customer has $9,000 in cash, and suddenly your $10,000 deposit turned into $19,000 worth of money. Then, that other customer deposits their $9,000 at their bank, which again holds on to 10% of it and lends out the rest, and so on and so on. You see where this is going. This is how banks increase the money supply, otherwise known as the total amount of money in circulation, without increasing the amount of physical cash moving around. The way how banks create money, could it be a problem? The Central Reserve Bank is both the linchpin and Achilles heel of a fractional reserve banking system. Monetarist economists claim a central bank is required to promote economic stability and growth in the economy. Any costs they maintain are outweighed by the benefits. Very few monetarists explain, though, that the bearers of the cost and receivers of the benefits are not the same people. By shrouding a reserve bank in an official cloak, bankers and economists fool people into believing that a little ink and paper and a lot of digits on a computer screen is just as good as sound money.